Welcome to the summer 2025 edition of MoneyLetter on Markets. I'm Brian Kelly, publisher of MoneyLetter. Thanks for joining me. With the markets having recovered from this year's February to April correction, nearly a bear market for the S&P 500, I thought I'd start this month's MoneyLetter on Markets with a story about the long-term benefits of investing in the stock market. It's called The Historical Perspective of Investing. Investing in the stock market has long been recognized as a powerful means to build wealth over time. While the stock market undoubtedly experiences ups and downs, historical evidence suggests that a long-term investment strategy can effectively navigate it. This article explores the importance of long-term investing, drawing lessons from historical market crashes, and offers some strategies for maintaining a long-term perspective amid market volatility. First, let's get into understanding long-term investing. This may seem obvious, but long-term investing involves purchasing and holding assets for an extended period of time, typically years or decades, with the expectation that they will appreciate over time. This approach is in contrast to short-term trading, which seeks to capitalize on immediate market movements. The primary advantage of long-term investing lies in the ability to ride out market volatility and benefit from the overall upward trajectory of the market. Now, here's a historical perspective: the Great Depression of 1929. In the exuberance of the Roaring '20s, investors flocked to the stock market, often purchasing stocks on margin, borrowing funds to amplify their buying power. This practice allowed individuals to invest with as little as 10% down, financing the remainder through loans. However, when stock prices began to decline, brokers issued margin calls demanding immediate repayment. Unable to cover these loans, many investors were forced to sell their holdings at significant losses, accelerating the market's downward spiral and culminating in the catastrophic crash of October 1929. The lesson is to exercise caution with leverage. While borrowing to invest can amplify gains, it also magnifies potential losses. A prudent long-term investment strategy prioritizes financial stability over speculative gains. Here's our second perspective: Black Monday, 1987. On October 19, 1987, known as Black Monday, the Dow Jones Industrial Average plummeted 22.6%, the largest single-day percentage drop in its history. This collapse was attributed to a combination of factors, including computerized program trading, overvalued stocks, and investor panic. The rapid sell-off was exacerbated by automated trading systems that triggered mass sales when certain thresholds were met, creating a feedback loop of declining prices. The lesson here is to diversify your investments and maintain composure during market volatility. Spreading assets across various classes can mitigate risk, and avoiding panic selling, which helps prevent locking in losses during temporary downturns. And who could forget the global financial crisis of 2008? Triggered by the collapse of the housing bubble and the proliferation of subprime mortgages, the 2008 financial crisis led to a severe global recession. Financial institutions faced significant losses due to their exposure to high-risk, mortgage-backed securities, resulting in widespread economic turmoil. The lesson on this one is to understand that your investments inside the broader economic context. The crisis highlighted the dangers of complex financial products and the importance of transparency. Investors should ensure they comprehend the instruments they invest in and remain aware of systemic risks. Now let's talk about the resilience of the stock market. Despite periodic downturns, the stock market has demonstrated remarkable resilience over the long term. For instance, the S&P 500 has experienced multiple bear markets, yet it has consistently rebounded and achieved new highs. This pattern underscores the market's inherent capacity for recovery and growth, reinforcing the value of a long-term investment approach. What are some of the benefits of long-term investing? First of all, compounding returns. Reinvesting earnings can lead to exponential growth over time, as returns generate their own returns. This compounding effect is a significant advantage of long-term investing. There's also the reduced impact of volatility. While short-term market fluctuations can be unsettling, their impact diminishes over a longer investment horizon. Long-term investors are better positioned to weather temporary downturns without making impulsive decisions. There are lower transaction costs. Frequent trading can incur substantial fees and taxes. A long-term strategy minimizes those costs by reducing the number of transactions. And there are tax advantages. In many jurisdictions, long-term capital gains are taxed at a lower rate than short-term gains, providing additional benefit to long-term investors. Here are some strategies for successful long-term investing. Diversification. Spreading investments across various asset classes and sectors can mitigate risk and enhance potential returns. Diversification reduces the impact of any single underperforming investment on the overall portfolio. Regular contributions. Consistently investing a fixed amount, regardless of market conditions, can lower the average cost per share over time, a strategy known as dollar cost averaging. This approach reduces the impact of volatility and builds wealth steadily. Staying informed. Keeping abreast of economic indicators and market trends enables investors to make informed decisions and adjust their strategies as needed. However, it's crucial to avoid reacting impulsively to short-term market news. And it's important to maintain patience and discipline. Maintaining a long-term perspective requires resisting the urge to react to short-term market movements. Staying on the course and adhering to a well-thought-out investment plan are key to achieving long-term financial goals. So what are some of the lessons from market downturns? Market downturns, while challenging, offer valuable lessons for long-term investors. First, avoid panic selling. Selling investments during a market decline can lock in losses. Historically, markets have rebounded, rewarding those who held their positions. Downturns provide opportunities to buy. Market downturns can present chances to purchase quality investments at reduced prices, positioning the portfolio for gains during the recovery phase. And you should reassess your risk tolerance. Experiencing a downturn can provide insight into one's comfort with risk, allowing for adjustments to the investment strategy to better align with personal risk tolerance. The historical perspective of investing. Here's what we conclude. Long-term investing is a proven strategy for building wealth, capable of withstanding the inherent volatility of the stock market. By focusing on long-term goals, diversifying portfolios, and maintaining discipline during market fluctuations, investors can navigate the ups and downs of the market and achieve financial success. Historical events like the Great Depression highlight the resilience of the market and underscore the importance of a steadfast, long-term investment approach. Let's continue by taking a look at our featured fund for July and August, and that fund is Fidelity Growth Strategies. The ticker is FDEGX. The fund is a domestic stock fund, and it's a mid-cap growth fund. For the year to date, it's up, this is through July 7th, the fund is up 13.3%. In 2024, it returned almost 27%. And the 5-year return on an annualized basis is 13.6%, so almost 14% per year over the last 5 years. I've got the top holdings here. Palantir Technologies is one stock that you may have heard of. It's been in the news quite a bit, and that comprises about 8.4% of the portfolio. Axon Enterprises 4.4%, AppLovin 3.5%, Roblox 1.9%, and WW Grainger at 1.9%. So these are names that are not the big names that you see all the time since they're mid-caps, but some of them you probably have heard of. Fidelity Growth Strategies invests in companies with market values between $2 billion and $10 billion that the fund managers believe are poised for growth. The top 5 sectors are information technology, 26.9%, industrials, 25.8%, financials, 12.7%, consumer discretionary, 11.8%, and healthcare, 7.2%. And this fund was added to the MoneyLetter Moderate and Venturesome strategies in January 2025, and it's served us well so far this year. So once again, that fund is Fidelity Growth Strategies, and the ticker is F Frank D Dog E Echo G Goat X, FDEGX. The next item we have is the world markets year-to-date returns, since we're at the halfway point, or a little bit past the halfway point. Here we'll give you an idea of how the stock markets have stacked up around the globe. We regularly track 7 indices. Here they're ranked by year-to-date returns through the midway point of 2025, June 30th. The returns do not include dividends. Number 1 on our list is Mexico. That's the Bolsa IPC, and that is up 16.0% for the year to date. Second is Brazil, the Ibovespa, plus 15.4%. Third is Europe, the Eurostoxx 50, 8.9%. Fourth is India, the S&P BSE Sensex, that's up 7%, 7.0. Fifth is the United States, the S&P 500, at up 5.5%. Sixth is China, the Shanghai Composite at plus 2.8%. And seventh and last on our list is Japan, the Nikkei 225, and that's up 1.5%. So unusually, all 7 markets are in the green for the time period. So for the first half of the year, the returns range between 1.5% for Japan all the way to 16% for Mexico, and the U.S. came in at 5.5%. For more information on our world markets, you can see the July issue of MoneyLetter. Moving on, with the Fed holding monetary policy so far in 2025, the Fed has held steady. Money market fund yields have remained stable as well. With the likelihood of 1 or 2 Fed cuts later this year, you might consider locking in today's relatively high rates with a certificate of deposit or CD. If you don't want to lock in your funds, there are some high-yielding money market accounts that are paying several points more than simple bank savings accounts. These are money market mutual funds. For example, T. Rowe Price Cash Reserves reported a 7-day yield of 4.16% in the July issue of MoneyLetter. Call us, and representatives at our sister company, Asset Strategy Advisors, can point you to even more solutions that make sense for your cash balances. Staying in the world of fixed income, here is our summer bond market ETF update. MoneyLetter Plus recently attended J.P. Morgan's presentation in Waltham, Mass., entitled Bon Voyage, Embarking on the Active Fixed Income ETF Journey. The panelists included Alessio DeLongis, Invesco's head of investments, Connor Durkin from Goldman Sachs Credit ETF and Portfolio Trading Operation, Priya Misra, J.P. Morgan's portfolio manager for Core Plus Bond, and Cheyenne Hussain, head of U.S. fixed income for J.P. Morgan. Here are some of the notable highlights from the luncheon. Since a 2019 regulatory change, actively managed ETFs have had a growth explosion, growing from 10% of the overall ETF market to 18%. The bulk of ETFs are passive or index-oriented. Priya Misra said that looking at the yield curve, it doesn't cost a lot to stay near 2 years. Since there is seemingly no political will to address national budget deficits, duration is tricky, and staying in the front end of the curve, 2 to 5 years, is sensible at this time. And Alessio DeLongis pointed out that bond investors are waiting for the Fed to normalize the yield curve. He thinks the duration imbalance will unwind fairly soon once the Fed begins to loosen monetary policy. Finally, if you're not a subscriber to MoneyLetter, you can start a subscription by visiting MoneyLetter.com, click subscribe, or by calling toll-free 800-890-9670. That's MoneyLetter.com, click subscribe, or call 800-890-9670. If you're a first-time subscriber, we have a half-price offer that will allow you to try MoneyLetter for a full year for only $64.50. Call us for more details. That's it for the summer edition of MoneyLetter on Markets. Remember, if you have any ideas for this feature, contact us by email at service@moneyletter.com. We appreciate you listening to our podcast and look forward to getting together again with you in September.